Bring in Gabriela Santos now of JPMorgan Asset Management. Welcome back. It's nice to see you.
Nice to see you.
Are the markets getting this right? Did they get what the Fed chair said correct?
I think so. I think what the Fed chair officially communicated was that they're still in a hawkish state of mind. But I do think the market is right to interpret several dovish signals that he sent as a sign to reduce expectations for another rate hike and to increase then the probability that the Fed is really done raising rates.
You think they're done?
We hope they're done, and we do think the odds have risen since yesterday that they're done. And that's because of several things he said. Chair Powell mentioned third quarter's very, very elevated growth, but mentioned that forecasts are for that growth to slow down. He also cited several improvements in the supply side of the economy, be it the jobs market, be it productivity that we got this morning. That means that resilient growth doesn't have to mean inflation pressure. And then lastly, he cited risks, including the tightening of financial conditions. So we do think he could have pushed back against expectations for no more hikes.
He didn't.
It didn't really happen.
He didn't, right? He had the chance to do it on multiple occasions, and he didn't do it. So given all that, has the equity position improved as a result?
I think this very broad-based recovery we're seeing in the market yesterday and today just signals how crucial this question of interest rates has been for every corner of the market. And the Fed is a piece of it, this uncertainty about the risk of rates going higher and uncertainty about what a neutral rate is. I think we got a little bit more clarity about that yesterday. What also happened yesterday was the question about the term premium and the move that we had seen in long end rates since late July. And what we heard is maybe there's a little bit less uncertainty about Treasury issuance going forward, and that the Treasury's listening, and we got a positive surprise with less issuance of long end Treasury, especially 10-year, 30-year bonds. So a little bit less uncertainty in general about the cost of capital means you can have a little bit more conviction about investing not just in interest rate sensitive stocks, but in cyclical stocks, in fixed income, in asset markets more broadly.
Wow. So this might have been a bit of a game changer in terms of the Treasury issuance, as you said, lower Powell's commentary yesterday. I mean, yields are obviously collapsing over a two-day period pretty dramatically, which leads people like Jeffrey Gundlach to say that, you know, bonds are the place to be. I want you to listen to what he told me yesterday.
I believe that we've started a bond rally here. I think we've had such a brutal increase. I think the Fed is sounding the right tone. I do think rates are going to fall as we move into a recession in the first part of next year.
All right, so here's the big question for you. The pressure's on. Are we going to have a bigger bond or stock rally?
That is such a good question. I think if we think about our base case, which is in the next 12 months, a soft landing, then our expectation is that yields have reached a peak at 5%, but they drift lower. So that suggests 5%-ish returns for the bond market, whereas for stocks, we're already at a correction of 10% from just the late July levels, even more than that from the all-time highs we had reached way back early last year. So we would say actually the probability is for stocks to do a little bit better than bonds, but we still feel like there's opportunities and urgency right now to lock in bond yields where they are, because what we find is the majority of investors might have an allocation to so-called fixed income, but really what that means is just ultra short cash, 3 months, 6 months T-bills. So really the urgency is to actually extend a bit duration and capture some of that 5% income.
One of the keys of what you just said was if there's a soft landing.
Exactly.
That's where it all, you know, the rubber meets the road.
Yeah.
It has to be a soft landing for that to work. If you have an orderly, measured decline in yields, stocks can do okay. If they start going down yields for the wrong reason, meaning we're worried about a recession, you know, sooner, that's a potential problem.
And that's where the risk reward for bonds actually is quite interesting. If we do get a soft landing, you can collect 5% and benefit from income if you've increased duration, of course. If there is a hard landing and yields fall, let's say 1% from here, that's not crazy, a little bit below 4%, then you could be talking about 12% return from something like the U.S. aggregate. So for fixed income, there are different scenarios that are possible, but the risk reward is quite favorable to add a little bit of duration from here.